The history shows, and there's a lot of evidence of it in a couple different cycles, that gold is more widely distributed. It tends to move first. But then Bitcoin follows it and follows it even harder. It goes up even more percentage-wise than gold. And by the way, gold went up 65% last year. That's only happened like once or twice in history. It was an amazing move. In my estimation now, within the next 16 to 18 months, something's going to break. And when it does, the Fed's going to be forced to print a lot of money to keep the system going. And that's going to be massively inflationary. It's going to be very good for gold, and it's going to be very good for Bitcoin. So that's kind of where I see the world today in a nutshell.
Welcome to Honest Money. I'm your host, Anja, and today's episode is brought to you by Hardblock. So joining me today on the Honest Money Show is a longtime sound money advocate and the author of The Big Print, which I'm sure many of you have read. Welcome to the show, Lawrence.
Very nice to be with you, Anja. Nice to meet you. Thanks for having me on your show.
You're very welcome. I'm so pleased you said yes and that we made this happen. So let's just start with an easy one. What got you into sound money to begin with?
Oh boy, it's a long journey. I'm 69, and I've been an investor, professional investor since the early 80s. And as most of your listeners probably know, the U.S. went off the gold standard, or the international gold standard, in 71. And my grandfather was very aware of that. My father was aware of it. So I kind of had a background in understanding that fiat was broken, even way back then, when it wasn't nearly as broken as it is now, and it's only kind of gotten worse. So I guess and they were gold bugs. So I guess I've always kind of been a gold bug. But it grew, over time. And the book actually outlines that, how with each step, things kind of got worse. We went off the gold standard, and then we bailed out Lockheed. And then, I don't know, there were just steps along the way. The 87 crash, and Greenspan printed money, and, the Greenspan put got born. And then, Glass-Steagall was destroyed, and all these various steps. It actually started way before 71. It started with the creation of the Fed in 1913. But what's been going on is it's just kind of gotten worse. And I actually didn't start out as completely 100% devoted to sound money. When I started my investing career, I was investing in technology. My sense was that I was around when the IBM PC was introduced in 1981. And I remember the guy who was running DEC, which was a big mini computer company at the time, said, "Well, I can't see why anyone would need one of these. You have a computer, you got to have a big one." And I think I kind of looked at him and thought, this guy's nuts. Everyone's going to want one of these when they get cheap enough. And so I realized there was going to be a lot of technology, changes as a result of microprocessors and such. So when I came out of business school, I became a technology investor in the venture capital industry. And, I did that for many, many years, from the early 80s into really almost until 2003. And in the background, I was kind of a sound money person. I was watching them debase the currency, and I was stacking gold and silver, but it wasn't my primary focus, right? I was trying to invest in companies that would grow and provide technological benefits. And of course, there was a lot of that, right? I was in Microsoft and all these. Look at all the tech giants of today were little companies way back when I started out, and so that all worked, and it was a good place to be. But when the tech bubble burst in 2000, the dot-com bubble burst, I'd kind of seen enough, and I was kind of frustrated with where that industry was going and how it was all working. And so I transitioned away from that, and I started just investing in what I call growth at a reasonable price, wherever it might be, technology or any other place. And I also took a bigger and more strong interest in sound money. And the reason for that is when LTCM blew up, Long-Term Capital Management, a hedge fund, blew up in 1998, they really organized a bailout and printed a lot of money to do it. And then when the tech bubble burst, they took interest rates down to 1%, and they blew the housing bubble. And you could see in year 2000, they got rid of Glass-Steagall, which was the law that separated the investment banks from the commercial banks, so that the investment banks could get highly levered up, which of course they did. And that's what led to the great financial crisis in '08, which, was what I call the first big print. And so I kind of, I transitioned more and more. The more cards I saw, the more I went like, holy shit, this sound money thing is more and more important than I realized. When Bernanke took rates to 1% after the dot-com bubble burst, or I guess it was Greenspan and then Bernanke, I was like, what? You can't have a 1% interest rates. That's nuts. And they made it very clear that they were going to try and reinflate the economy by, getting a housing boom going, and they did. And of course, then when that burst, they took rates to zero, and not just one, they had zero interest rate policy when that burst. And so all these monetary machinations are so out of the ordinary and so extraordinary. And of course, everyone today just looks at them like, oh, that was just normal. That's just the way things are. But it wasn't. I mean,
Mm.
prior to this, if you told somebody in the 70s, the federal government's going to take interest rates to zero, they'd have looked at you like, you're out of your mind. There's no possible way that can happen. Capital can't be free. But guess what? It did happen. And so, the first big print was 2000, the second one, or 2008, the second one was COVID. They took them to zero again. And in the 2008 examples, we know they expanded their balance sheet by 3 trillion. And in 2020, they expanded by 5+ trillion. And so, this monetary debasement, sound money thing has become more and more and more important, right? It's really front and center right now. And I feel like we're heading towards a climax where, we're gonna we're in something that I call the fourth turning. We can go and discuss that if you want. I think most of your listeners probably know what that is.
Yeah.
Big societal changes are taking place. And I think they're taking place in terms of, how's the system going to operate, and can we have a debt-based monetary system, without it eventually kind of quote unquote blowing up? Because the U.S. is very close to going through the $40 trillion debt limit, and it took us 180 some odd years to get to 36 trillion. We got the last four in a handful of years, so it's nuts, right? And so it's very clear to me that sound money is kind of the problem of our age, and I don't think that many people really understand it. Bitcoiners understand it, gold bugs understand it, but and we all think that we think, oh, everybody must understand this because we understand. But if you really go out and talk to your family and friends and the person on the street and the stock market investors, most people have no clue what's going on with this stuff. And which is kind of amazing to me because it's pretty obvious. And so, in light of the fact that I think it's going to lead to a lot of changes, and I think a lot of people who don't have a clue will get hurt in the coming, reset or revaluation of these things. That's why I wrote the book, was to try to help the average person, maybe somebody who doesn't have an economics degree or not necessarily in business. I mean, I wanted to write it at a level that, a blue collar, any worker, anyone with a brain could read it and go, oh, I kind of get it. The system is set up so that they have to debase the currency, and I'm getting screwed by inflation, and that's why. And then, the natural conclusion is, okay, well, given that's the case, what do I do to protect myself? Right. And of course, the book lays out the case for both gold and Bitcoin, with Bitcoin being a stronger case than gold, but they both have a case for sound money. So that's kind of the background of how I got here. And, right now I'm just kind of pounding the table, and I'm still very convinced that what I've described is going to happen. But to be fair, I mean, I've been early. I thought it was going to happen like right after I wrote the book. And I wrote the book in February, it came out in February of 25. So it's over a year and a half old now. Hasn't happened yet. I mean, it's kind of happening. They're printing a little bit of money, but it's not big yet. So there we are.
Yeah. So for people who haven't read your book, how would you define the big print, and how does it compare to the little prints on the ongoing printing that's happening?
That's a great question, and just so yeah, I mean, they're kind of, money supply is expanding all the time, and if you read the book, you'll come to understand the money supply expands when the banks create loans and they loan money into existence. And more recently, I've just noticed that the M2 in the United States is increasing at something like 5.5% a year, which, by the way, is higher than the reported rate of inflation. I mean, to me, the true rate of inflation is the money supply growth, the growth of M2 over time, which has averaged about 7 or 8%. And the CPI that the government reports is kind of a lie. It's always understates what the real inflation is. But in any case, the government, there is a print going on all the time as a result of the banks loaning money into existence. And right now, actually, and the banks do that. And as they do that, they get more levered. And if they get too levered and they get out too far out over their skis, they blow up. And that's what happened in '08, right? And so then the Fed had to come in and buy a bunch of bonds and create a bunch of reserves for the banks. And the bank, until I guess sometime last year, Jerome Powell, who was the Fed chairman in the United States, was draining reserves out of the banking system because they put so many in during COVID. I mean, the Fed balance sheet during COVID went from 3 trillion to 9 trillion, high 3 trillion. So they added about 5 trillion of reserves. And when that took place, we had massive inflation, right? We had 9% inflation here at the peak in the United States. And they realized that was a problem. So they started draining reserves. They started quantitative tightening to sop up all that extra money. But they got to the point where they couldn't do that anymore because, the credit structure was crumbling a little bit. And so they started something that they call, reserve management program, which they claim is not QE and they claim is not printing money, but both of those claims are lies. I mean, they are printing money, just not a lot. That reserve management program has kind of been ranging between 10 and 40 billion dollars a month, whereas in the peak of the QE periods they were printing hundreds of billions of dollars a month. So what we got going on right now is kind of a little print, not a big print. You asked kind of what would be a big print. Well, a big print would be, and what would drive. First of all, let's talk about what might drive a big print. Generally speaking, these big prints have occurred. If you look at the last two, they're really kind of been more than that, because LTCM blowing up in '98 was a little bit of a print as well. But let's take the two big ones. The Fed balance sheet was less than $1 trillion until the 2008 crisis. It was like $890 billion. And, the banks failed. AIG blew up. Lehman failed. The whole system was prepared to go down. And Bernanke, printed enough money to keep it alive. And that dollar amount started off at about $1 trillion and then grew to $3 trillion over the course of several years. So that was just raw printing of money through the clicking of a computer key and putting the reserves in banks when that money did not exist before, full stop. So that was a big print. $3 trillion is a lot, especially even though it's over 3 years, it's still a lot, especially when you started at 900 billion as your balance sheet. So you quadrupled your balance sheet in 3 years.
Quick one for the Aussies listening. Hardblock is offering a $10 sign-up discount right now. And if you're with another exchange, ask yourself this: are they Australia's longest running Bitcoin-only exchange? Because if not, maybe it's time to switch. Head to hardblock.com.au/join/honest money and start stacking sats today.
It's a lot of money. Okay, so fine. But then they started to tighten after that. And Janet Yellen did start to quantitatively tighten, and they raised interest rates slowly. And after the economy had somewhat recovered, although they kept them at zero for a long, long time. And 0% interest rates are really just a crime against humanity. The whole notion that capital is free is just like, what? If money is free, then it has no value. If you can borrow money for 0%, it's a tautology. It doesn't make any sense. But anyway, setting that aside, things started getting tight again. And in 2019, the repo market blew out and rates shot up to 10% very quickly, and Powell panicked. And he immediately turned around. He was quantitatively tightening, and he immediately turned around and he cut rates and he started quantitatively easing. And then COVID hit and it got even worse. And, if you think the GFC big print was big at 3 trillion over, 3 years, 3.5 years, take a look at the COVID one, right? It was 5 trillion over 18 months. So that's a big print. So if you want to ask when's the next one, I think the next one occurs when something breaks, because the Fed really has three mandates, right? The Fed is supposed to be monitoring employment and inflation. Those are the two stated mandates in the Fed's charter, since they revised it in '78. And they talk about that a lot. But they have a third mandate they don't really talk about, but it's there. And it's the shadow mandate, which is I call keep the system functioning, And even in his recent testimony in front of Congress, the new Fed chairman, Kevin Warsh, said, look, I want to shrink the balance sheet, all other things being equal, but, and I'm summarizing this, these aren't his exact words, but just I'm summarizing it. All other things being equal, if there's some kind of a liquidity crisis, we stand ready to print the money and grow the balance sheet. And so really, the bottom line is at the end of the day, the Fed is the lender of last resort, which is kind of what it was set up to be, by the way, when they set it up. They set it up back in 1913 because of the panic in 1907 when JP Morgan bailed everybody out. And they thought, well, the next time this happens, there might be not be a JP Morgan around. We need to have the government in a position to bail everybody out. And of course, they immediately did, with World War I, and then they did again after the Depression and when the stock market burst in '29. But the point is, the Fed stands ready to print more money. So something needs to break, in my opinion, for the next big print. And your natural question might be, well, is anything breaking? And what are the top clues?
Yeah.
And the top clues are that Japan right now is experiencing a real, increase in the rates and a real decline in the currency. And, if you think we're over leveraged, you go look at Japan. The U.S. has debt to GDP of about 125%. Japan's debt to GDP is well over 200%. And so, and everybody's used that since that was a very cheap currency, and they kept their interest rates lower longer than anybody else. A lot of people borrowed in Japanese yen, and then they used that money, invested it somewhere else, and that was kind of a one-way ticket to making money. It was called the yen carry trade. And now that's kind of, unwinding and reversing. And so that's a piece of liquidity that's being taken out of the market. And, as a result of that, I think one of the things that happened recently that your viewers may or may not be aware of is that about a week or two ago, Treasury Secretary Scott Bessent said, we're concerned about the Japanese yen. We want to help our good ally Japan, and we're going to intervene to support the yen. We're going to sell the euros that we hold in our treasury reserves, and we're going to buy Japanese yen to support the yen. We're not going to let it go through 164, 163 where it was. And they jammed it down very quickly in a few days into the 150s. They also said, and I think this is even more important than just we're going to swap some euros for yen. He also said the Federal Reserve has a program called FEMA. That's just an abbreviation, but basically what it is it's a swap line whereby the Federal Reserve can send dollars to Japan. You might ask, well, why would you want to do that? Well,
Yeah.
as it turns out, Japan owns $1.2 trillion of the U.S. debt, and the U.S. interest expenses are now 1.3 trillion gross. And to the degree that our interest rates go up, our deficit gets even worse than it already is. And it's pretty bad right now. It's running at 7% of GDP. And so the US has a very strong interest in telling Japan, please don't sell our debt. And Japan's like, well, we need to sell the debt because we want two things. We want to defend our currency. And two, all the oil we're buying is now getting more expensive because the yen is depreciating against oil. And so we say to them, no, don't sell your bonds. Hang on to your bonds, and we will pledge them to us, and we will send you newly created currency. Well, where did that newly created currency come from? It's a mouse click. They literally say, here, Japan, have $100 billion, on the swap line. Now, the swap line is 60 billion, which is a big amount. I mean, that's a large number. And the thing I think really freaked the market out is that, and I'm not sure, I think he'd probably regret having done this. Secretary Bessent said, yeah, we've got a $60 billion swap line with Japan that may get used. And by the way, that may need to get bigger. And everyone's like, what? 60 billion is not enough to solve this problem. 60 billion is a lot of money. And so I think, when he said that, gold went up 7%. The week he said that, gold went up 7%. Gold miners went up 17%. This was either last week or the week before. And it was kind of like, whoa, that's a big deal. And so, to my way of seeing it, the debasement trade, which is what I'm in, and a lot of people who are in Bitcoin and gold and silver miners are in, had kind of taken it on the chin since, we did very well last year, right? Gold was up 65% last year. Silver went up 4x. I mean, silver, at some point last year, silver was at 30. In February this year, it was 120. That's 4x. And Bitcoin, by the way, until October last year was doing great. It was at 124. That was up a ton, but it was a big number. And then, Kevin Warsh got nominated, and he had written an op-ed for the Wall Street Journal. And he talked about how, basically in the past, and this was a few years back, but he thought the Fed expanding its balance sheet was a mistake, that led to inflation. So I think the world interpreted him as being a hawk, and that he was going to come in and jack rates and get inflation under control. And certainly all his rhetoric says, oh, I'm going to get this all under control. But in fact, those of us who know how it all works realize that he can't be a hawk. I mean, yes, he wants to be. And of course, he's going to jawbone the fact that I'm going to get inflation under control. That doesn't mean he will, right? So, and I think what happened with the Bessent comment a couple of weeks ago is everybody kind of woke up and said, whoa, this is different. The Fed's going to print money to support Japan. Well, that's not getting inflation under control. That's printing more money. And so that's what led gold to take off. And then, all the Bitcoin holders, who are still unsatisfied because we haven't broken through 64, my comment would be just be patient, because, the history shows, and there's a lot of evidence of it, a couple different cycles, that gold is more widely distributed. It tends to move first, but then Bitcoin follows it, and follows it even harder, and goes up even more percentage-wise than gold. And by the way, gold went up 65% last year. That's only happened like once or twice in history. It was an amazing move. And it occurred in my mind because what happened when Trump got elected, he created this DOGE, the Department of Government Efficiency, department. And they were going to solve the budget deficit. Remember Elon Musk and Vivek?
Remember.
Right? Remember all that? And they're
Yep.
going to take out $2 trillion, then they were going to take out $1 trillion, they were going to balance the budget. And everyone's like, why do you need gold and silver? Why do you need Bitcoin? You don't need that stuff. The dollar's going to be good as gold. I mean, they're going to balance, the Fed's going to, and of course, as we all know now, DOGE was a spectacular failure. I mean, three or 4 months of it, Elon looking at it, and he was like, "This is ridiculous. I
Yes,
can't fix it.
hands up.
Yeah, I'm out of here. You
Yeah.
guys are broken, and I can't fix it. I'm out of here. I'm going to go make rockets." So he left, and when that failed, in my view, that's what lit the fire under gold, and everyone said, "Oh, I get it. These deficits are not coming down, and as long as they're running big deficits, they have to issue debt to support, to pay for things, and the debt burden keeps getting bigger, the interest burden keeps getting bigger, and I'm sure you and most of your listeners are familiar with the concept of a doom loop, which is if rates go up, interest costs go up. If interest costs go up, deficits get bigger. If deficits get bigger, you got to sell more bonds. All else equal, same number of buyers, more bonds being sold, rates go up higher. And this is, it's a doom loop. It's a death spiral. And this is not unusual. This has happened historically in smaller, poorly managed countries. I mean, this is not a pattern that's unknown to macro analysts. I mean, it happened in Venezuela, it happened in Zimbabwe, it happened in Weimar Germany in the 20s. It's happened hundreds of times. It happened in Ecuador in 2000. I mean, there are a lot of examples of it. It's never happened. It hasn't, generally speaking, it hasn't happened in a big country that was the world's reserve currency. Okay. So it's a little different and it's going to take longer, but it's kind of like, it's kind of like a formula. If you do the same things, ultimately you're going to get the same result. I mean, if you keep running a big deficit and you keep printing money to pay for it, ultimately you're going to have a lot of inflation and it's going to become a doom loop and you're going to have a problem. So, that's where we are now. Where things don't work, where I'm wrong, is if the U.S. federal government gets sane and balances its budget. And I say that to people, and they laugh, and I do too. I mean, the odds of that aren't high, particularly when you got guys like the Department of War guy Hegseth. Recently said, if you want me to win this war, you got to give me $1.5 trillion instead of 900 billion. Well, that's an extra 600 trillion, and we're already running a $2.1 trillion deficit right now. And we need another 600 to win the war. I mean, it's crazy. There's as you can, if you don't live in America, but if you did, you would see there is zero political will to balance the budget, and it probably won't get done until something breaks. And so, my thesis, the book's thesis, is sooner or later, probably in my estimation now, I feel like we're in 2007, maybe 2008. In my estimation now, within the next 16 to 18 months, something's going to break. And when it does, the Fed's going to be forced to print a lot of money to keep the system going. And that's going to be massively inflationary. It's going to be very good for gold, and it's going to be very good for Bitcoin. So that's kind of where I see the world today in a nutshell.
Do you see any other potential events other than the Japan breaking? Could there be anything else that you've kind of?
Yeah, that's a great question. I mean, there are a lot of little things on the margin. I mean, so let's just go back and look at 2008. And when the 2008 example, 2020 was slightly different because you had this, worldwide shutdown due to a disease or, a manufactured disease. But 2008, you had an over-leveraged system that was just crazy over-leveraged, but you could see it. You could see it in the banks, you could see it in the insurance companies, you could see it in the housing market, all of it. It was all nuts. You could, Michael Burry saw it, I saw it, a lot of people saw it, and we all made bets about it. You can kind of see it now, but it's a little bit better hidden. I mean, there's a lot of stress. I mean, a lot of the leverage today isn't necessarily in the public market, although margin debt's pretty high compared to the size of the market. You can see it in private credit, which has become a big thing in the United States. And, it's interesting to me that there's a lot of leverage, and obviously private credit is borrowing. And so a lot of companies have gotten levered up with private credit. A lot of people invest in private credit. It's interesting now, I think there are problems there because most of the large private credit guys have said, sorry, we're restricting withdrawals. You can't take your money out. And what that tells me is that the marks aren't accurate, that the stuff is overvalued. And so, there's a problem there. There's a problem in commercial real estate in the United States. I mean, what we're doing here with a, StreamYard or Zoom, as we now know, post-COVID, the demand for office space declined, not to zero, but a lot. And so there were a lot of office buildings in the United States that were worth a fraction of what they used to be worth because people weren't going to the office and people didn't need as much office space. And, so there's a commercial real estate, credit issue. Although, again, a lot of that's owned by insurance companies, a lot of it's owned privately, a lot of it's owned in banks. It's somewhat hidden. And then probably the mother of all these, which you're probably waiting for me to come to, but it's very obvious just because it is out there in the public, is AI and all the hyperscalers and the amount of money that we're putting into AI. And it's just, look, I use Chat GPT, and I use Claude almost every day, and I find them incredibly productivity enhancing in terms of information and doing my job, correctly. And I'm sure many other people do too, and I'm sure they will change the world. But just as, I remember very clearly the internet bubble, and we put a lot of money went into, Global Crossing and, WorldCom and all these people who were laying fiber. Those weren't the companies that benefited from it. There was a lot of overcapacity, and it was other companies that benefited from those early investments. And I see that same kind of thing going on today. People are just throwing money at hyperscalers. They're throwing money at data centers. They're throwing money at the AI providing companies. And yet, there's some evidence that that money isn't necessarily being well invested, and that the demand for it, the revenue piece that makes those in good investments will be slower to show up than people think, and it'll probably show up in a way that people don't entirely see right now. I mean, when the dot-com boom happened, you couldn't really see that, Facebook was going to be a thing, or that how big Google was going to become, or how big Amazon was going to become. I mean, Amazon was just selling books. Now it's the largest online retailer in the world, right? So those things weren't obvious at that time, and I suspect the same is true with this AI boom. There will be big, important businesses, huge changes, great productivity enhancers, but not, the people who invested in it right now aren't necessarily going to be people who reap those rewards. I think that, at some point in time, this credit creation thing, and by the way, the U.S. GDP I think now is growing about 2% a year, but there's some studies that I've read that show that if not for all this AI capex, all this AI investment in chips and data centers and so on and so forth, we would be shrinking. The U.S. economy would not be growing. So, we're making a huge bet on this stuff, and it better work. And my sense is at some point it'll be obvious maybe that it's not working as expected, and these stocks will start to turn over. I mean, I think it's even interesting. I mean, you kind of saw a little bit of that, where SpaceX came out at an offering price, traded well above it on its open, shot up to north of 200,
Yeah.
and then crashed and lost over half its value. Now it's kind of coming back a bit. Probably now I see it back up above its offering price, just barely. But the point is that all these businesses ultimately have to be supported. The valuations have to be supported by revenue and cash flow.
Need a way to sign, verify, and secure your Bitcoin? Australia's one-stop shop for Bitcoiners has you covered. From signing devices, nodes, and backup solutions to BitAxes, Decor, and apparel. Visit shopbitcoin.com.au.
And I think a lot of assumptions have been made that may not come true. So that's another potential risk issue slash problem. It's hard to know. It's hard to know what snowflake will trigger the avalanche, right? And but I think that there is a lot of credit in the system. There is a lot of debt in the system. The stock market is trading at nosebleed valuations on any historical basis, and all the old timers who've seen a lot of bubbles, guys like Jeremy Grantham and others, have just said this is the biggest bubble I've ever seen, and it will end badly. But to be honest with you, I don't know when. And I've tried to short the stock market from time to time. It hasn't worked. I mean, it just keeps going. And the S&P right now is at 7691. I mean, who am I to say it won't go to 8,000, 9,000, 10,000? It could go to 12,000. I mean, who knows where it goes? I mean, certainly what the administration is trying to do is run it hot. And, these asset values going up they keep everybody feeling good about themselves and feeling good about their retirement accounts and feeling like they can keep spending. But if it ever gets working in reverse, as we saw in 2008, or 2000, the leverage works the other way too. I mean, from peak to trough in 2000, all the technology companies, the NASDAQ technology index lost 82% of its value. So, that's not good. That's a lot of money going to money heaven. So, that could happen with AI. And I'm not predicting it will, but I'm just saying, it has a little bit of the same feel to it. So,
Yeah. Well, many expected a big spending spree in the lead up to the midterms, but that
yeah.
hasn't really happened. Like, how do you read that?
Well, they did do the big, beautiful bill, and they have spent a lot on the war. And, I think the interesting thing that hasn't happened, I think pre the war, um, Kevin Warsh was setting everybody up to cut interest rates. He made a strong argument that he said multiple times that the productivity coming from AI was going to increase output in such a way that he could cut rates without it being inflationary. That's what he said. He
Yeah.
also has had a supply side view of the world, which says if we cut rates, that'll lead to more capital expenditures. CapEx leads to more supply, all else equal, leads to lower prices. So the right way to actually fight inflation is not to raise rates, the old model that Volcker used and Powell used, but it's actually to cut rates and grow your way out of it. It's what we call a run it hot strategy. And so I think, that was kind of where they were. Now, he said all those things before we declared war and we sent the price of oil up a lot. And now all the inflation prints really suck. And so, he's kind of caught in betwixt and between. The market is saying they think he's going to raise rates. I don't think so. I think he will make an argument not to raise rates. And by the way, 3 Fed governors voted to raise rates in the last meeting. I mean, to me, that's all just theater. They just want to make it seem like there's this incredibly intelligent, thoughtful, and deliberative body setting interest rates, when frankly, they're just pulling it out of their ass. I mean, and seriously, they really are.
Yeah.
They're just making this shit up as they go along. And their job is to gaslight us and to make us think there's not going to be any more inflation. And we all know there's going to have to be more inflation. So I think there's some chance he'll actually cut rates, before the midterms in September. I know that's a very out there opinion, but I think it's possible. And the way he would do it is, he's created this interesting device. If you've watched him, he says he's going to create all these task force, right? And so he's got an inflation measures task force. And so he can get a bunch of experts in a room who say, you know what, inflation's really overstated. I mean, I happen to think it's vastly understated based on my personal experience, but he can say it's overstated. There's this measure called trueflation, which is quite low. And, you can chat GPT it, you can see it uses some different inputs. And I think he, and furthermore, this device of a task force is really neat because what he can do is he can say, hey, it's not just me. These experts told me this, and he kind of remains blameless, right? So my sense is he can, he might come, his task force might come back and say, gosh, rates are, inflation's not as bad as we're saying. This war will get solved and oil will come down. We're gonna look through it, and we're gonna cut rates. So we'll have to see. I mean, we'll just have to see.
I have a community question. How do you think about credit contraction and deleveraging, like GFC style deleveraging and China's weak bank lending as an offset to money creation?
Well, yeah, I mean, that's a great question. I mean, obviously, when credit-based systems deleverage, things, usually it's because debts are going bad and debts fail. And so, I call it the money goes to money heaven, right? The money no longer exists. I mean, if a debt is no longer good, it's no longer in the system. So it's a reduction in M2. And of course, that's what leads to the massive printing that they do to try and fill up the hole that got created from the deleveraging and the debt going bad. And the problem is, and I mean, in an ideal world, they'd match the two perfectly, right? And they would create just enough money to, stop the deleveraging and not so much money that there was inflation. But, the point here is, how can any body of people sitting around a table, looking at numbers historically, know what that correct number is? Do you know what I mean? I mean, the problem with this whole damn system, and I mean, you go back to my youth and they were always joking about the Soviet system. The problem they had was they were setting prices by committee. And, if you set the price of grain by committee and you miss, you either get way too much grain because farmers overproduce, or not enough grain because they can't make money at the price you set. So what we're doing here is we're setting the price of interest rates by committee. And, by definition, they're always going to be wrong because the committee doesn't really know what the market needs. I mean, this is the argument in my book, that the interest rate should be a market set rate based on the balance between people who have savings and the people who need capital. It should balance the two out, right? And so it's a market price, not a committee price. And that's really the problem that these central banks have, that they're trying to do something that they can't really do. But they pretend like they're experts at it and it's all going to be fine. But in reality, they just stumble from one mistake to the next. And, right now he's trying to convince everybody we got no inflation. And look, inflation is lower than when we were at 9%. I'm okay. I believe that. That's true. I mean, Powell did sop up some of the excess money with his higher rates and QT. But, at some point in time, The point I try to make over and over again is that my argument isn't really, it's not just it's not an emotional argument. It's almost a mathematical argument that if credit continues to expand at a rate in excess of the growth of the underlying GDP, the only way to square that circle is to have more money supply expand as well, or else the credit can't get serviced. I mean, that's the bottom line. And that's just math. There's nothing more than math. And so with that as kind of a premise of how the system operates, what happens is the Fed stumbles between, tightening and trying to get inflation under control, and then things get too tight, something breaks, and then they have to print like crazy, and then they get another inflationary outburst, right? And so we go back and forth. And I've said often in the past, it's like you're driving a car on an icy road and you're bouncing off the guardrails. You steer right, you go hit that guardrail, and too much inflation, tighten up. And then you steer left, too much deflation, all the debts are failing, and then you turn right again. That's kind of what's going on. I mean, a chart of the Federal Reserve or the Fed funds rate kind of shows that. I don't have one right at my fingertips, but if you take go to St. Louis Fred site and look at the Fed funds rate for the last 20 years. I mean, they jack it up, something breaks, it falls down. They jack it up, something breaks, it falls down. I mean, this pattern repeats itself. And, my sense is, Powell jacked it up, but I think we're getting close to something breaking again. And at that point in time, they're going to have to create more money, and we're going to get another inflationary impulse. I mean, the other point I would make is that, we've been in a period of deflation, natural deflation. And by the way, the world is naturally deflationary. I mean, look at your TVs are cheaper, your computers are cheaper, technology is getting better. I mean, humans over time get better at doing everything. And deflation is the condition that an economy should operate in. But because the monetary system requires inflation and a credit-based system requires inflation, it's in conflict with a deflationary system. And, when the money was sounder, relatively speaking, from, 1980 after Volcker jacked rates up to 2020, we had kind of a generally benign deflationary trend. And we had some things that supported that. You had the whole computer boom. Everyone got PCs. Everyone got more efficient. You had the internet. Communication became cheaper. I mean, there were a lot of great deflationary things that happened in that time frame. You had the Chinese market open up in 2000. Suddenly, you had half a billion or a billion people that were willing to work for a fraction of what we would work for. They made all kinds of great stuff cheap, right? So that was deflationary. But in 2020, something really changed, and everyone kind of thought, well, deflation's a problem. I mean, I remember the Fed talking about it in 2015 and 16. We failed at our mandate. Our inflation rate's only 0 or 1%. We got to get it higher. I was like, what? You know, and so, but they got disabused of that notion very quickly when 2020 came along and they printed a ton of money and they got inflation, not just a little, a lot. And they said it was transitory, and they're wrong. And what we're now seeing is, 40 years of a deflationary trend and underinvestment in stuff and overinvestment in financialization is getting reversed. And so financialization is going to get less valuable and stuff is going to become more valuable, which is why, the price of oil is going up, the price of copper is going up, gold is going up, silver is going up, everything is going up. Everything that's real that you can, molecules that you can touch, they're getting more expensive. Bonds that represent paper commitments to give you money in the future, they're getting less valuable because those paper commitments are less valuable if they keep printing money. So it's just kind of a natural shift in the system right now. And until, in my opinion, until this monetary problem gets resolved, we live in an inflationary world, and we just can't stop that. Sometimes it'll be really high, sometimes it'll be low. When we got to 9, we come back to 3, 4. I think the next wave up takes us into double digits. We get to 10, 11, 12, 13, easily, when they have to print again. So.
Yeah. I think the thought on everyone's mind is how long they can keep kicking this can down the road. And I believe Lynn Alden recently said in a podcast that she believes it's going to be more like a gradual ongoing print as opposed to one big print. Like, what are your thoughts on that?
Yeah, no, Lynn's super smart. She's a friend, and I love her book, and I use parts of it to help me write my book. She could be right. I mean, they could just kind of continually, gradually kick the can, but even in that scenario, that's inflationary, and that benefits gold and Bitcoin. I personally think that there will be another big print. I don't, and I personally think that it'll definitely happen, soon, in the next year or two. But I've been wrong a lot. And I've been wrong before, and it could be more than that, longer than that. I mean, they are good at can kicking. I mean, a good example of that is, Silicon Valley Bank failed in 2023 when Powell started raising rates, and they had all these bonds. They were on the long side of stuff. And so it became rapidly noticeable that they were bankrupt. And so they failed. And, honestly, there was 17 trillion of bank deposits at the time. The FDIC fund, which insures those bank deposits, 17 trillion of insured bank deposits, was like 187 billion. So 187 billion doesn't really cover 17 trillion. And, Janet Yellen was freaked out. And even though, Dodd-Frank and the laws from Dodd-Frank had said, you're never going to be able to bail out the banks again. They did. They violated the law, and they more or less promised all the banks that they would guarantee those deposits if need be. And then they found a home for Silicon Valley, and they found a home for First Republic, and they calmed everybody down. But there was a moment there when it was looking like it was going to be a run on the bank system, and so yeah, they're pretty good, at papering things over. And Lynn could be right. I mean, it could be a gradual print. But even a gradual print's inflationary. So even in a gradual print benefits our investment thesis as against bonds. And I'm of the opinion that given animal spirits and given what I see going on in the markets and given the nature of the way everything works, that there's going to be another blow up. I mean, look at
Given
this.
also, I guess, what's happened in the past, because there have been some like little big prints, if that makes sense.
Well,
So
that's right. That's right. I mean, there've been small ones. And the thing that's interesting in today's world that I think is different a little bit than '08, although '08 we had the internet and all, but is just how incredibly connected everybody is and how rapidly things spread and how fast the information gets around. I mean, in this 2023, when Silicon Valley Bank, what happened with Silicon Valley Bank is they sold a bond below their cost and took a loss, and they recorded the loss. They had to. And so that came out, and it was a public statement of that. And then some sharp penciled guy in Silicon Valley or financial analyst looked at this and said, holy shit, look at these bonds. They're really not worth what they're carrying them for. Oh my God, this bank is bankrupt. I mean, these, if they mark all this to market, they've got negative equity of $20 billion. And then he called up, some of the big venture capitalists who had all their money there, and their portfolio companies had all their money there. And he said, hey, you realize this bank's in trouble. They don't have the capital they say they have. And if I were you, I'd move my money out of there. And of course, that one venture capitalist called another venture capital. I mean, the word spread. And within a week, basically the place they had failed. And there was a day, I think they had like 80 or 90 billion in deposits. There was a day where they had $40 billion of withdrawals in one day. It was like 40% of their deposit base just disappeared, got vaporized in like a day. And so, I'm not suggesting this will happen with the dollar or this will happen with the US bond market. But what I am suggesting is that when everybody kind of figures something out, and it's like the fire in the theater, you're in a theater, there are a couple of exits, somebody smells smoke. If you guys hit the exits, fine. Everybody smells smoke. Man, everyone goes to the exits fast, right? And so, I'm just giving you a scenario here. You wake up some morning and the Japanese yen has fallen 10%, and Japanese yields are up 10%, and the US Treasury yields are up 10% all at once, and everybody's like, holy shit, what does this mean? Oh my God, well, maybe, there's a pattern here. Maybe I got to get out of this stuff. And then one person calls another person, and before you know it, off you go. And then, what happens? Well, the Fed has to step in, right? They have to step in to calm the market down. So we stand ready. We've got these lending facilities, we've got these swap lines. We've got all these programs, calm down, everybody. There's no need to panic. We've got this. And they do. They do have it. They can do it. I mean, in 2020 COVID, the world was falling apart. The US Treasury market had gone no bid. And Powell came in with 10 programs, and he said he did his best Mario Draghi invitation. He said, we'll do whatever it takes. And he printed tons of money. He started off printing small amounts, and then month by month, he had to keep increasing those because they did whatever, and they want to get ahead of it in a big way. And so in so doing, they're trying to prevent a financial panic. And in so doing, they print a shitload of money. And, okay. So everyone, and so the thing is, Anna, the thing is that currencies fail when everyone realizes they can never stop printing. that's if you study all the hyperinflations of history, when a majority of the people realize, oh my God, this is a system that can never stop.
Not your keys, not your coins. If you're holding Bitcoin, your self-custody setup needs to be done right. MindRacks delivers paranoia-grade security so that you can sleep at night knowing that your money is protected. Take control and secure your money the honest way. Head to mindracks.com/honest money.
Then everybody, this is the smoke in the theater. You know, this smoke, that fire is burning. The smoke is. I'm going to die if I don't get out of here. Right? I mean, that's how currencies fail. We're not near that point yet. Okay, not even close. All right, but my point is that, you know, and this is the gradually that's then suddenly that some Bitcoiners use. I mean, you know, if and when something big happens, I mean, so we had a big print in '08, we had another one in 2020. Each of those brought more money into the sound money camp, right? Each of those made more of us aware of how broken the system is and how it's designed to steal our wealth by printing, okay? I mean, you know, I remember back in '80, and I talk about sound money. I mean, people, '80s and '90s, people thought I was nuts. I mean, there wasn't half a percentage of the population that understood the monetary system like I did and thought I was right. Okay. But now, I mean, you know, you got to admit, we got a lot of Bitcoiners, we got a lot of gold bugs, we got, I don't know, I mean, what are we as a percentage of the total population? 1%, 2%, maybe 5% to be generous. Certainly not 50 or 90%. I mean, it's a small piece. If you look at your friend group, most people think you're crazy. But there are a lot of us, and it's growing. And guess what? When they print again, that 5 or 10 will become 10 or 15 or 20. And then pretty soon that 10 or 15 or 20 will become 30 or 40. When that tips over 50 or 60, everybody will be like, what the fuck? They're just going to keep printing forever.
Yeah.
I'm out of here. You know, I'm
Yeah.
just out of here. I'm not holding these dollars anymore. Right. So
Yeah.
that's kind of where we're going now. Like, you know, it takes time, right? It takes time. It takes cycles and, you know, so forth. So it's not happening tomorrow, but that's the direction pretty clearly in my mind.
Yeah, well, I got called a debasement cultist, but one thing that I always want,
There you go.
yeah, I tried Five Gentlemen on LinkedIn.
Yeah.
But one thing that I always wonder is if, like, obviously central bankers are aware of this, and I wonder if this is the reason why they're trying to implement CBDCs, is so they can actually program money to save the system from collapsing.
Yeah, let's talk about that. That's a really interesting point, and it's clearly a piece of the puzzle. And it also is to try and enforce dollar dominance and to try and find buyers for the treasury bills. I mean, as we all know, Tether and Circle, the two leading CBDC, well, the two leading what I would call stable coins, but we might as well call them CBDCs now because they're both underneath the government purview, and the government now knows who owns what, and it's proven that it can seize that shit. So, unlike Bitcoin, that the government can't seize unless it gets your keys, the government can go to Tether, the government can go to Circle and say, "Hey, this guy's a bad actor. This is Iran. We want you to, wipe out these deposits," and they can. So that's kind of a CBDC, a stable coin. But these stablecoin companies, as you know, a big piece of their holdings, they hold gold too, but a big piece of their holdings are treasury bills. And so that's nice. I mean, when you're Scott Bessent, you got a lot of treasury bills to sell in order to finance the government. You want to see people use stablecoins. And in my opinion, the original stablecoin use case arrived because when we seized the Russian reserves in 2022, a lot of countries, and we shut down the SWIFT system to these countries like Russia and Iran and so forth, these countries were left without a way to pay for stuff. And I've met Russian businessmen and others at shows like at the Prague show that I went to, Bitcoin show, who said to me, basically stablecoins rose and got used because if you were doing business outside of the US SWIFT system, how were you going to pay somebody? How were you going to send them $500,000? You couldn't. But, you could buy a stable-coin and do it as a crypto transaction. You could, it's easy. You didn't need a bank, none of that. And so that's why the whole stablecoin market came to be. It was an alternative set of rails to the US SWIFT system, which, when we grabbed the reserves, we proved that, if we don't like you, you don't want to be there. And so, but yes, they are trying to get the stablecoins to solve the problem. Here's the thing. They tout it as the stablecoins will save us. It's going to create more dollar dominance. Everyone's going to want to transact in stablecoins. US going to be a crypto leader, blah, 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 blah. Okay, fine. But here's the thing. US got $40 trillion of debt. I think 30 trillion of it's, external, 10 is internal. We got to roll over $8 or $9 trillion a year. Okay, total stablecoin market right now is about $300 billion. So even, and not all of that's used to buy treasury bills, probably a big percentage is. Let's say all of it was. So stablecoins buying 300 billion of treasury bills when you've got to roll over 9 trillion, that's not really moving the needle. I mean, it's not, and by the way, the 300 billion used to be growing pretty rapidly. That growth has really slowed down. In fact, the last time I looked, it was kind of flat to shrinking a little bit. So I don't think the stable coins are going to solve their government debt problem. But I do think you pointed out, yeah, they are kind of CBDCs. And people who think that, gee, I'm just going to hold my capital in a stable coin, I wouldn't do that. And the reason I wouldn't do it is because the government can grab it. But the government can't grab Bitcoin. So, yeah, that's kind of my view on the stablecoin market.
Yeah. Now, objective data. One of the things that I guess a lot of plebs were looking at, and I'd love to understand this better because M2 was always so closely correlated with Bitcoin, but now it's become decoupled. So why do you think that is?
Well, the correlation was a longer term correlation. It wasn't perfect. Bitcoin to me is a little bit of a liquidity smoke alarm. And I think part of the reason why Bitcoin is down, it has a little bit of a tech component to it. It has a little bit of a shiny object component to it, and it has a little bit of a liquidity component to it. People are buying gold. They know what they're buying. They know why they're buying it. They tend to take a long-term view. That is pure debasement insurance. Bitcoin hasn't really. Some of us know it as debasement insurance, but because of the volatility, a lot of people don't view it as that yet. They view it more as a liquidity widget. And right now, liquidity is tight. But that's also why, let's assume I'm right, and at some point in time, we don't just gradual print like Lynn says, we bigger print, or somewhere between gradual and big, and we get going again on the upside here. That's why gold will probably go from call it 4,500 today to 7,000. So what's that, 70%? But Bitcoin's going from 60 to 180. When the liquidity spigots get turned back on, Bitcoin's going to triple. I think it's one instructive thing I think it's worth kind of going through, because I remember this period very well, and I think a lot of people don't understand, what happened. So let's go back to the COVID example, right? So it's March of 2020. World's ending. Treasury market goes no bid. Stock market's down 20, 30% in 3 weeks. It's a horror show. Gold's down, silver's down, everything's down. There is no bid for anything. There is not enough liquidity in the system. It's a mess. So I remember it very clearly because I was sitting in my house. Powell comes in on a Monday morning and literally just says, we are going to print until our eyes bleed. We're going to do everything we need to keep the system going. Okay. And gold just immediately grabbed that. It was like, holy shit. And, gold shot from, 1,200 to 2,000 in months, probably 2 months at max. Just bang. And gold stocks even more, right? They just went straight up. Bitcoin, which had, when the whole thing occurred, was probably in the 7, 8, 9, 10,000 range. And I'm talking average numbers. And some people, say, well, you're off a little bit. But by memory, I'm just, when the whole thing occurred, Bitcoin was, call it 8, 9, 10, and it maybe dipped down to 5, when the whole liquidity thing occurred and everything was breaking. And then Powell came in and, sprayed money everywhere. Gold took off, and Bitcoin came back to its 10, where it was kind of before the whole thing happened. But it sat there at 10 for some time. So now it's March of 2020. And by the way, gold topped out around 2,000, 2,100, and the stocks went up. And they kind of, it moved first. And it moved meaningfully. 2,000 up from 1,300. That's a big move, but especially for gold. But it's not, enormous. So Bitcoin's just bumping along at 10, plus or minus 10, 10, 10, 10, 10, all. And I remember, because I was in both, and I remember all my Bitcoin friends going, what the fuck? They're printing a ton of money. Gold's taking off. Our shit's not moving at all. It's driving me nuts. And then in October, Bitcoin woke up and it went from 10 to 60, right? Over the next 8 months, right? It did a 6-bagger, right? And that's because the liquidity finally got into the system and everybody realized what was going on. Everybody realized Bitcoin had a fixed supply. And it's like, holy shit, this thing is really undervalued. And, gold's had its move. Now it's Bitcoin's turn. And so I kind of think that's probably what'll happen again here, right? I mean, gold will, they'll start to print. Gold will smell it first. It's already starting to smell it, in my opinion. It's up off the bottom. I think the bottom is in on gold for this correction. I mean, from 5,500 down to 40 something, 4,000 something, right around 4,000. And gold will smell it first, and it'll start moving, and gold will get more momentum, more momentum, more momentum. Something will break. They'll really print. Gold will take off. Maybe there'll be a little lag, but then eventually Bitcoin will, like I said, I think gold goes up, 50 to 70%. I think Bitcoin triples. We go to 180. So, I mean, that's just kind of, based on past experience and the models that I use, that's kind of how I see it playing out. Can't say when. I kind of feel like we're imminent. I mean, this reminds me right now, kind of reminds me of the summer of '07. Maybe the summer of '08. It's kind of I'm kind of torn. Summer of '07, the housing market was starting to crack. The Bear Stearns CDS stuff blew out. The Countrywide Mortgage, which is the biggest lender, subprime lender, failed. In March of '08, Bear Stearns failed. Summer of '08, Fannie and Freddie reported terrible numbers, and it became clear. And then, of course, in the fall of '08, all hell broke loose. So if we're in the summer of '07, we've got maybe 14 months to wait. If we're in the summer of '08, we've got maybe 3 or 4 months to wait. And I don't know, we're probably somewhere between those two boundary conditions where, I think something is going to happen in the next year. I really do. It's going to
Well,
force them to print.
it will be really interesting to see how it plays out. But for
Yeah.
listeners who, are like now thinking how to invest their money, do you have an opinion on the optimum kind of portfolio allocation between gold, Bitcoin, and other assets?
Well, sure. I mean, so this is very individual to every person. I mean, I think I always tell people thinking buying Bitcoin, look, the first thing you got to understand, this is the most volatile asset in the world. And if you can't handle that volatility, don't buy it. And the way I always say, what I say is no matter where it is, you should expect that it's gone down 90%, 80%, 70%, 60% historically. Each drawdown, by the way, is getting percentage-wise smaller. This one's about 54, which is if the 58,000 low holds. So it could go down, and it could go down 50% from here. If we have a correlation of one event, something blows up. Sure, could Bitcoin go to 20, 30, 40? Possibly. I don't think it will, but it could briefly until they print money. So I always say, the way to look at Bitcoin is to buy a number where if it went down 50%, you would think to yourself, this is on sale, it's great, I'm going to buy more, rather than I made a mistake and I'm going to sell it when it's down. Because in a 4 to 6 year context, it's always gone up, and it's higher highs and higher lows. So, that's kind of the Bitcoin piece. I mean, the gold piece is much stabler. It doesn't go up as much. It doesn't go down as much. And it's analog sound money. Bitcoin's digital sound money. And then stocks, I think, are very highly valued, but they do kind of protect you from inflation because they grow with the economy. I don't think they're going to grow much in real terms when measured against gold. But they can't print stocks, although stock companies can issue more stock. Housing, same story. I mean, they can't print houses, but you got to pay taxes, and you got all kinds of other issues with housing, maintenance and repairs. So I think it's really it's really specific to every individual. But the thing I would say that's important, I think, and I've noticed in today's world, is it just such an incredible focus on the short term and on short term getting rich, and on these poly markets and gambling, and I think that's part of the broken fiat system. Everybody's just kind of like, how do I get there fast? And having been an investor for my entire career, and watching the people who succeed, I'm telling you, they get the big trend right, and they place their bet on it, and then they have patience, and they let compounding do its thing. And if you sit with a financial calculator, I mean, I think the Bitcoin ARR is going to be north of 25% for the next 40 years. And so whatever number you start with, if you put that in, you put in a 25% IRR, you're going to end up very, very well off. I mean, it's, that kind of a compound growth of an investment. It's very hard to find that. And one of the things I really like about Bitcoin compared to stocks is there's no management team. I mean, they can't fuck it up. There
It's the
is.
free market.
Yeah, right. Well, there's the free market, but and there's core, which is a little bit of an issue. But the point is that it's a protocol that's pretty set in stone now, and it's been ironed out for 16 years, and it just tick tock, next block just keeps running. So now there are risks. I mean, a lot of people say, well, Bitcoin's going to get, captured and taken over like gold, and there's going to be paper Bitcoin. And there is some paper Bitcoin, but the thing that makes it different than gold is gold's never gone up 6x in 8 months. And so, yeah, people can sell paper Bitcoin, but look out, because if they do and it goes up 5x, they're going to get their ass handed to them. So, I think, I guess what I try to say to people who are looking at this is everybody should have some Bitcoin. The wrong answer is 0. Now, if you don't like volatility, fine, put 5% in, because if it goes down 50%, you've lost 2.5% of your capital, you'll live. But my personal view is it's going to go up 10x from here, and then it's going to go 10x again. Now, that may take 15 years, but, going up 10x twice, that's 100 times your money. So if you put 2.5% of your capital in it, it becomes 250% of your capital today. Now, the only problem with that is that, whatever it becomes, one of the things that's hard is I'm pretty sure Bitcoin will be $1 million in 2032 based on the power law model. But I also am afraid that gasoline might be $20 a gallon in 2032. So, look, this is the game we play, right? You have to find something that beats inflation. Assuming you have savings, right? You have to find investments which will beat inflation. And I think that the sound money assets are your best bet in today's world. So that's.
Yep. Well, final question for you, Lawrence. Thank you so much, obviously, for coming on the show. And for the listeners who have not bought and read his book, I highly recommend it. It's a really, really good read. But do you have any final kind of words of hope for people who...
No, I really don't. Look, it's, these are tough times, but I think anybody throughout history would argue that, they had a different set of problems they dealt with. People dealt with World War II and the Cold War. And it's, they're tough times, and it's the worst of times and the best of times, right? The beautiful thing is we got incredible technology, and we can talk from other sides of the world. We can broadcast to anybody. There's never a better time to be able to educate yourself online. You don't need a college degree anymore. You can get online and basically become smarter than a lot of other people who've got a degree. And, that's a beautiful thing. I think that it is accurate to say that there will be some financial turmoil in the next 10 years, and that people who understand these issues and prepare for it are going to come out the other side a little better off than those who don't. And that's why I wrote the book, was to try to help the average person. And I think, some people have said, well, you're a doomer. And I'm like, no, I'm not a doomer. I'm just an analyst of the system and what is. And I think based on that, you can kind of predict that there's going to have to be a real big change. The thing I would say that's very optimistic and positive, and I view myself as an optimist and a positive person, is that we will solve this problem, Anja. We will get through this. Sound money is the problem of our age. There'll be some other problem in the future. AI wants to take over the world or whatever, but but that's not today's problem. Today's problem is sound money, and it's going to get resolved, in my opinion, in the next 10 years. And then we're going to be back on a sound money standard, because everyone's going to realize the alternative is worse. The bad news is we've got to live through the time when the alternative is a little bit worse, and inflation is going to really hurt a lot of people. The good news is that once we fix it on the other side, my kids and my someday grandkids are going to have a much better world to live in, where they have a different set of problems. So, I would say that that's the thing to look forward to. And, I wrote the book to try to push people to understand these issues so that they can protect themselves, one, but also so that they can become advocates, because to the degree that we all advocate for sound money, educate people about sound money, explain to the world what's happening, then as these problems become more and more apparent, we'll get more and more people going, hey, you know what? That really is the core issue. Let's solve it. Because, let's not forget, this is not an unsolvable problem. And this is a very solvable problem if we go back to sound money. It's totally solvable. I'm not suggesting that'll be painless. It won't. It'll have pain. But on the other side of that, it'll be very good. So I try to be optimistic about it. I try and convince people to be positive about what we're going through, and recognize this is just the set of conditions we got to deal with.
Excellent. Well, thank you so much for your time.
Oh,
I really enjoyed this chat.
enjoyed speaking with you, and hopefully we can do it again.
Awesome. Thanks, Lawrence.
Okay, thank you.
Still here? You're one of the good ones. We'll be back next week with a brand new episode. If you enjoy how we cut through the noise, consider supporting us directly via the Lightning QR code. Got a question or a thought to share? Comments are wide open. We'd love to hear from you. For bonus content and updates, follow us on socials at Honest Money Show. Until next week, take care of yourself and your money and stay decentralized.